when silver and gold go up like this, like they have, I'm getting a lot of questions
Everybody
like, should I buy it?
asks.
Should I buy it?
Yes.
Well, I think, that's a very different conversation today than it was a year ago.
In this episode, the speakers discuss annuities. Any guarantees apply only to contractual obligations of the issuing insurance company.
All thoughts and opinions shared in this recording belong to the participants. This podcast is meant to inform and educate and should not be seen as solicitation or endorsement for business.
Welcome to the Market Moment. This is Matt Walters here with John
Morning.
and Isaac.
Hello.
And I don't know why we're laughing.
It was the wave coming off guard.
Yeah.
I was waving to everybody.
John makes everything awkward. But no, we're super excited to be here. Got a good topic today that we're going to talk through, and then a little kind of current events with what's going on with gold and silver. So anything before we pop things off?
Super Bowl week,
Super Bowl week.
the Pro Bowl.
Oh, yeah, Super Bowl week.
The Pro Bowl.
Yeah.
Shedeur Sanders in the Pro
Shedeur
Bowl.
Sanders.
Super.
Pro
They
Bowler.
should just give this up.
Bill Belichick
So
not in the
bad.
Hall of Fame and Shedeur Sanders in the Pro Bowl. What is going on?
Wild times right now.
Welcome to 2026.
Exactly.
Yeah. I forgot about Super Bowl coming up. That'd be fun. Okay. So main topic for today is how to build a diversified portfolio that fits your risk tolerance. All right. So it's kind of like it's one of those topics that's like, well, that sounds pretty simple, right? But when you dig into it, like, this is hard. This is really hard. And the reason it's hard is because if you build a portfolio, every portfolio should be somewhat dynamic.
Yeah.
That evolves. Now, the hard part to that is, like, you don't want it to be overly dynamic where you're thinking about it all the time.
Yeah.
Making changes every time something little happen. But you can't be too fixed. You want to make the right adjustments when they need to be made. The hard part about building a portfolio that fits your risk tolerance, that's broadly diversified, is it has to be something that you can stick with, both in the bad times, but also the good times. So I've talked a lot about in the past, like, fear and greed. Those are the two things that drive the markets and drive people's decision making when it comes to investing. Fear, when things are getting bad, it's like, oh, I want out, I want to take less risk, blah, blah, blah. And greed, it's like, if you are invested more conservatively and things are going really well, and you're like, I'm up 6%, the market's up 12, like, I want 12, and then you start making adjustments because you're missing out on potential upside. And so building a portfolio that you can stick with in both the bad times and the good times is a lot harder than it sounds.
It is.
And so I think it's a great topic to talk through today. So, John, when you think about building a portfolio, trying to align someone's portfolio with their risk tolerance, something that they can stick with, like, so what are some things that you take into consideration or that come to mind?
This is a great topic. I agree with everything you said because I see it right now with a 16-year bull market with weird things like gold, Bitcoin, silver being part of the equation, all this stuff. I see a lot of people just being swept up into the wave of this stuff and thinking it's going to last forever and not realizing their risk tolerance. And this is the way I look at it. Can you handle? So go back to 2025, April 1st, tariffs came out, people were afraid, market sold off on fear. So there's fear selling, created a 20% plus downturn in a really short amount of time, 3-week time frame. Now, we had the fastest recovery from that 22% downturn in market history as well. So it was a very quick downturn. But here's my point. If you're invested in the market and you can't handle that, your portfolio went down 22% and you lost sleep and you can't handle it, then you are not in the proper risk profile for yourself. So it's very easy to be aggressive when things are great, and it's can you handle the negative side to that? So you need to know what you can handle, what your stomach can handle. So I think that's the first thing. Find out what your risk tolerance is. We do a little questionnaire, 100-point type of thing, and it comes out, anywhere from 20 to 100.
Yeah.
And that tells us a little bit about you, right?
It's a piece of the puzzle that's kind of, it asks you, like, how would you feel if your portfolio was down X in X amount of time? And,
this is a great question on that thing is, what would happen if the market went down, your portfolio went down 25% in 2 days?
Yeah.
That's one of the questions. What would you do? And the answers are, go to cash, go more conservative, stay the course for 3 months, add more or go more aggressive or add more funds, right? Well, that tells me a lot about your stomach, what you can handle that question, right? And nobody wants to be down 25% in 2 days, first of all. But the point is, like,
It's happened. And we need to know how you would react.
We need to know how you'd react. And I think that's the first thing. So even if you're not with us or you're by yourself, whatever, know that.
Yeah.
Number one, know what you can handle. And then if you know what you can handle, I could go on forever.
Yeah.
You also, when you do a retirement plan, just to tie something
It kind
else
of
into
feels
that-
like you already are. But
I know I'm over talking. I'm sorry, fans. So when you do a market, when you do like a financial plan, even if it's through your 401k site or whatever, and it tells you need to make this amount of percent of return for the rest of your life, or this is what we expect you to make, and you're going to be great, right? Or whatever it needs to be. Know what that correlates to the risk tolerance that you're taking. I think that's important too, because if you only need to make 6%, because you've already saved enough, you're on the right path, and you're an aggressive portfolio and your stomach can't handle that aggressive, and the aggressive goes down 25% and you go down with it, you have fallen off like the right path for you. You should have been less aggressive in the first place.
Right.
I mean, there's so many factors, but I think knowing what you can handle, knowing what you need to handle to achieve your goals, then doing a proper allocation to address, whether that's moderate, conservative, aggressive, whatever you're in, and then sticking to the course of that with rebalancing, making sure you look at it all the time. Because the other mistake you can make, you can have a diversified portfolio, feel great about it, be whatever, moderate, aggressive, whatever. Things get out of whack. You don't change it for 5 years, and all of a sudden that moderate portfolio we had a 60-40 split is now 80-20 because bonds were bad and the stocks did great, and you don't change it.
Yeah.
And I think that's another key factor is like, get that back to balance. Like you're always selling profit and you're buying things at a lower, like no matter which way that turns.
Yeah.
Right. And I think rebalancing, knowing your number and knowing what you need to have is what I would say is the most important stuff. Whew. Okay, I'll stop talking.
You made a point that I wanted to talk about was like when your portfolio does get kind of out of whack and maybe the more aggressive piece grows because when those things run, they run, right? And it's going to get out of balance. Not having the greed to say, well, let's leave it, right? Like
Let's let it run.
Let's let it run. It's doing great. And, investing sometimes can be so short-sighted where it's like you just look at the past 6 months and you're like, well, it's been doing fine. And by the time you're comfortable, like, okay, I think the market's a little wobbly, it's too late.
Yeah.
Right? Like
a lot of times,
you've experienced it. And so one of the things that I always have to tell people, I had this conversation yesterday, was like, by the time you want to act on what the market's doing, it's too late.
Yeah.
And if you want to act before, now you have to be right twice.
Yeah.
So not only do you have to be right when you're getting out, but then you have to be right getting back in. And a lot of times you don't want to get back in if you were wrong the first time. So you wait for it to come down, and sometimes it doesn't. And now you're on the sideline for 2 years.
Well, and even something as simple as
exactly.
rebalancing can be hard because you want everything to be data driven, right? Based on like because if you rebalance too frequently, you're not giving
You're not
your
letting things run,
allocations
sure.
the investments that you have the opportunity to work.
Yeah.
And if you rebalance,
not enough,
then you're exposed to maybe more risk or being too conservative and out of line with your risk tolerance. So this is, it's investing, and I've said this, I feel like I've said this every time on the podcast the last 4 times, but it's like access to investments has never been easier.
Yeah, exactly.
Managing the psychological component and the portfolio and knowing when to take action, when not to take action, keeping your portfolio aligned with your risk tolerance, I would argue maybe has never been more difficult. And so just don't oversimplify it, because it's easy in today's world with technology, access to investments, to say this is easy, and it is in some regards, but have a process. Either have an advisor that you trust that knows what they're doing, or have a rules-based approach that you're following to a T, and have a process, because if you don't, that's when you're going to get blown up. And you just have to stick to it. So when you think about a diversified portfolio, most people immediately go to stocks and bonds. How much in stocks, how much in bonds? Fixed income, equities, whatever. What are some other things that you guys think of, that should be considered, maybe shouldn't be, and every situation is different, but when you're building a diversified portfolio?
Yeah, I mean, it's especially, I deal with it a lot here just because of my role, but annuities are a piece of a portfolio that I think kind of get a bad rap because you don't have to be financial advice license to sell them.
Yeah.
Right. And so there's a lot of people out there doing it the wrong way. But they're actually such a great piece to de-risk a portfolio and still get a little bit of a return out of it.
Yeah.
Right. And so like in a way an annuity works, if you don't have one, it's a contract with an insurance company. You can get a fixed rate. You can get a cap to an investment, but it sets a floor on what you put into it. And so it won't go down when the market turns down. And so having somewhere that's a little bit safer, you can access a little bit of the cash. Because at the end of the day, we're planning for people's living their lives, and they need money to live their lives. And the last place you want to pull money from when the market's down is the market.
Yeah.
I want to add something to this
Sure,
before I
please.
lose. I'm older.
Yeah.
I lose my train of thought. People out there that are older, they understand what I'm saying. I forgot what I was going to say. So on the annuity side, this
Yeah.
is a great point. Like I look at like diversification, going back to the models.
Yeah.
If you look at modern portfolio management, which I've learned back
Yeah.
in way long ago, where you put a person in a 60-40 model, 60 equity, 40 bond. That was the old case. For 10 plus years, that has not worked, right? It did not work, or 15 years, because interest rates were so low, bonds did not give you what they historically had done. So that was a real drag on the portfolio. So the alternative to that, and we've done that here, was fixed indexed annuities where you get that floor, you get to capture some of the market,
Yeah.
but you're not taking the risk, right? So you're taking the risk off, which is what the bonds are supposed to do, but you're actually giving yourself a chance for bigger growth than what the bonds were actually giving.
Yeah.
Yeah.
Now, bonds, again, having somebody to talk to, bonds may get back in favor here sooner than later because
Yeah.
we have new Fed chairman coming, things are going to be different, and so on. So you have to be aware of that. Like for the last 15 years, I have not done a whole lot of bonds, but the next 15, they might be attractive again. So
Right.
you switch maybe from that annuity idea back to the normal.
A few years ago, we
portfolio.
had like almost zero fixed income in our portfolios.
And now we're starting
that's
to
very different
build it back
today.
in.
And
Yeah.
yeah, and I think with annuities, it's like anything. Like it's not right. They're not necessarily right for everyone.
Sure.
Right, especially the younger investors. But if you're older and you're trying to manage risk, they can be a great option. And then another note that I wanted to add is there are 6 dozen different types of annuities,
Yeah.
right?
Yeah.
And they all do
Yeah.
things
Yeah.
well. They do things poorly. Some are structured to do one specific thing very, very well, and then it's horrible
Yep.
at everything else. And so there's not like a right or wrong. It's not that
Yeah.
annuities are good or bad. It's that what are you trying to accomplish, and is there a product that fits and helps you accomplish that? And there may or may not be.
Yeah.
But we often find that if it's someone that's nearing retirement, in retirement, they're needing income, they're needing some safety. An annuity is something that we consider. Don't recommend to everybody, but
Yeah.
we definitely consider, and it's an option.
When you do an annuity, just make sure you know what you're doing.
Yeah.
I think that's the key. Like what fees are you paying if you're paying any? What's your term? Just know all those things. And I think have the most knowledge you can, and you will not make a mistake. So there are bad ones out there. I'm going to go back to diversify. You're asking that question. What are the things when we talk about it? So stocks is the piece that stocks and bonds, right? That was the old way to think of it. But stocks aren't just stocks. Think of small cap, large cap, mid cap, size of the company, that type of thing. And it matters.
100%.
Large cap has been running hot for the last 10 plus years. Small cap is not. So it matters how you
International didn't do anything forever.
Right. And
last year crushed, right?
crushed.
And so people had been allocated to. We didn't have a lot of international exposure, which
we've
worked,
added though.
which worked
We've
well. But
worked
we've
with the
added
times,
and
yeah.
we've increased it
Yeah.
incrementally as of late. But for a long time, if you had an international allocation, you're like, why do we have this?
Yeah, exactly.
Like this has not worked, and it's so hard to like stick with it when there's a part of your portfolio like large cap U.S. technology is like that's working,
killing
It's like,
it, yeah.
Well, why don't we just put everything in that, right? And it can be really hard, especially when it's year after year after year after year. All it takes though is one moment in time, one bad year, one bad quarter. Then things go really south, and you're going to be like, "Oh, I get why we didn't want to own 100% of one thing."
Exactly.
Right?
Now, okay, so geography matters. So U.S. versus international, and then not just international, but emerging versus developed. And you have sectors. So technology, healthcare, energy, financials. So you have to, sometimes that's a part of a portfolio. Do we pick a specific sector and avoid another sector and all that? Then bonds, of course, we talked about bonds, and there's different types of bonds, high yield, government, all that kind of stuff. Then alternatives, which has been the hot topic.
Which I would caution. So just like on the annuity thing, great. can make a ton of sense. We use a lot of them. But be careful, know what you're getting into. The same thing on alternatives, like they're a hot topic right now.
Hot topic.
We've been exploring and kind of doing due diligence and looking, and know what you're getting.
Exactly.
Know the good, because it can be kind of like an insurance contract that like can be easy to sell because of some of the bells and whistles. But if you don't know what you're getting, not only do you know if you don't know what you're getting into, but if you don't know why you're getting into it, like why are we doing this? Like, is it just because it's what everyone's talking about and we feel like we should? Or is it because it's actually going to help us achieve what we want to achieve? And that's where we've been a little more cautious, because you look at like the private credit space and private equity, and everything's private. And they're giving smaller investors more access to these kinds of investments, and great. I'm not saying any of that's bad. It's just it's easy to sell, but it doesn't mean that's what you need.
And we can talk about gold and silver, and I know you have personal stories of funny stories about gold and silver, but I can tell you this, going back to a long time ago, I've been hearing, and the commercials have been on TV forever, buy silver, buy gold, that's the thing. And those were on forever, like for 20 plus years, and they didn't move.
Yeah.
So if you went into that, because William Devane told you to on a commercial, whatever, and you did that, for years it did nothing. I've had clients that had silver and got rid of it because it didn't move for 15 years. All of a sudden it goes up 4 times in a year.
Yeah.
Well, that's pure, I hate to say this, but it's like kind of luck. If you lucked into that, great. But for 20 years, you've been hearing how great that was. And then finally 1 year it works. And then until it doesn't.
But if you own it, know why you own it. And it shouldn't matter that it doesn't do anything for 10 years.
You're right. Like it's a piece of the portfolio you're owning as a hedge.
The outcome, Warren Buffett has the quote, you judge a decision by the information you had at the time you made the decision, not by the outcome and what ends up happening. Like, did I have, based on the information I had when I made that decision, was it the right decision, regardless of if it worked out or not? And so I think you have to look at like why you hold gold and silver, why you have access to private markets, why you have an annuity. Like, was it the right decision based on the information you had at the time? If that's yes, then like don't change that because 3 years later
it's not working.
It hasn't
exactly.
done what you hoped it would do.
Yeah, I agree.
Right, and so it goes back to knowing why you own something. If you own gold and silver because you're concerned of X, Y, and Z, and you want to hedge, and you're worried about hyperinflation, and you want even more of a broadly diversified portfolio, then you have to know, hey, I might sit here for a decade and it might not do anything. Right. But that doesn't mean you shouldn't own it.
No, and it goes back to, I think earlier in this podcast we were talking about the emotions and fear, and so one of the fears is fear of missing out.
Yeah.
And I think now it's kind of a very interesting time if you're looking at all these things. That's why I think it's good to always talk and have an advisor and be able to talk through this stuff, because there are going to be when silver and gold go up like this, like they have, I'm getting a lot of questions.
Everybody
should
asks.
I buy it? Should I buy it?
Yes.
Well, I think, that's a very different conversation today than it was a year ago.
And you shouldn't buy it because it's gone up in the last year.
Exactly. You shouldn't buy it because of that, right? You should buy it because you believe it's a hedge and it's going to work and all that, if that makes sense.
Yeah.
So anyway,
we talked about traditional stocks and bonds, equity side of things, not getting too fixated. Everybody talks about the S&P 500. It's great. It's worked well. It's outperformed everything.
Yeah.
Right?
Yeah.
You have to know you're 100% exposed to U.S. large cap companies. Probably not the best allocation for someone who's worried about volatility.
Yeah.
Right.
If you're 20, that might be perfectly fine.
Yeah.
But if you're not, then, it may not be. So knowing what you should own, small cap, mid cap, international, what percent of each, what is it doing in your portfolio? On the fixed income side, having exposure to, government, short term,
different types
long
of
term,
high yield,
all of the stuff. Considering gold and silver, commodities in general, where do they fit, if they do, inside your portfolio? Insurance company, policies, contracts, life insurance, annuities. There's a place for all of it.
Yeah.
And there's clients that need every one of those in their portfolio, and there are clients that need a couple of them or one of them, right? And so just know that you have to try to build a portfolio. The goal is to build a portfolio that you can stick with in both the good times and the bad. which is a lot harder to do in the moment than it sounds, right?
I
Because
agree.
if you're quote unquote leaving money on the table because you're taking less risk than the market, you have to be okay with that, right? So I don't know. Any other thoughts or comments?
No,
on
I
that?
think all the stuff we hit on was pretty broad, big, and covered a lot of what the
and
diversified
rebalance before you
portfolio.
don't rebalance too often.
Yeah.
But rebalance before you feel like you want to.
Yes.
Because when you want to, it's probably because something just happened.
Yeah.
So I will harp on the rebalancing. Rebalancing is important because think about every time you rebalance, you're buying more shares of the things that did poorly in your portfolio and you're selling things that did well. But if you do it every month, you're missing out on a ride. But if you do it once a year, let's say,
Yeah.
I'd say once a year is probably,
And that's what we look at in a lot of our models. We look at it doing it twice a year.
right. Potentially twice a year, but
Potentially, but more often than not, it kind of a larger portion of it happens once a year.
yeah, once a year is like, I think, probably a good idea because then you are buying more shares of something else. And remember this when we talk about large cap. Today, large cap growth has been leading the market for a long time. And so you get complacent that that's the only thing. But if you go back 100 years, small cap stocks is actually number one returning sector.
Sure.
International's number 2. And then you have our broad large cap stock number 3.
Oh, yeah.
Well, but people can say, well, the times have changed. International small cap are never going to come again. But I would say just 100 years of history says that that's not the case. Like there's going to be some time where it's going to turn.
Yeah.
But it may be less dramatic. 100 years ago was probably more small companies were
Maybe.
Maybe. We don't know. But that's the rule of like recency versus like a broad portfolio, that there's reasons to have a broad portfolio.
Yeah.
Blah. I'm doing a lot of word salads today. Sorry about that.
Any other things that you guys want to talk about? We were going to mention just briefly, won't spend too much time on this, but the move in gold and silver last week, right? We were talking about this earlier, but you see this a lot in the commodity space. Won't do anything for a long time, and then you'll see these like violent moves, both to the upside and the downside.
Which
so
we have seen that.
Gold and silver, had a really good run here for 12, 18 months, and then we saw a pretty material move to the downside. End of last week, all kind of within a day or two. Silver's up today, like 10%. So you just see these big swing in commodities, precious metals, and those types of assets from time to time, which, again, if you don't know why you own them, it can be hard to stick with it.
Yeah.
Right? If you know why you own it and you know what it's doing for you and why you have it in your portfolio, then none of it, it all should be really kind of noise.
Yep.
So just have a plan of, both a financial plan, but also an investment plan. Why do you own what you own? And as long as you know that, then you're a lot better off than a lot of people, and probably a lot more likely to stick with your allocation and probably do pretty well over time.
I want to give you guys this quick on the silver. A year ago, it was at $28 an ounce. Just a few days ago, it was $105 an ounce. Mm-hmm. It fell to $75 an ounce in a day or 2 days of trading, right? And it's back up to 79. That is what you're talking about, a massive drop, 30% drop in a few days of trading.
Yeah.
But if you held it for a year, you've done really well.
You still made money.
Right.
Yeah.
It's all perspective and all relative. But that's
100%.
another, like a rebalancing side thing. Mm-hmm. If you have something run up like that, maybe, like you said, we might look at 6 months instead of a year. That might be a time where you look at something if it's run up that much.
Run up
and
quickly.
Then you might rebalance stuff like
partial
that.
even a
partial rebalance. Yeah. Anyway.
Yep. All right. Well, just know that fear and greed is what drives markets. So be aware of that. Be aware of how it affects your decisions and how you view your portfolio, and don't let yourself get caught up in either one. And you're probably gonna benefit from just being aware of that. All right. Any other parting thoughts or words? Has y'all's first show aired or no?
Our first show is going to be.
No, the answer is no.
I think this
We're gonna know from the
Friday is
producer.
when it comes out.
We
I'm
don't-
looking at
we
Eric.
don't know.
We're not quite sure. I think this Friday it comes out.
When
Is that what we think?
executive producer doesn't know, then that's not.
And we have been shopping names, right? And we
Yeah.
have a couple names we're throwing around, and I think I like one specific. So we'll drop
Agreed.
it on the podcast.
Yeah, I know everybody's on the edge of their seats waiting for
this is a
John
big
and
deal.
Isaac
A
to
lot
dive
of
deep
people.
into some topics.
Yeah, you're
But,
just
yeah.
putting more pressure on yourself.
There's no pressure.
Isaac and John's new investing kind of economic show where they talk all things markets and economy and kind of have fun with that. Pretty laid back conversational,
Yeah.
which will be fun. We'll be coming out here in the coming weeks. Eli's data brief is still coming out every 2 weeks, so be on the lookout for that. He does a great job kind of diving into the weeds and the details of very specific topics. So trying to build out the content library just for more and more value that's out there that you can go watch, listen to, and hopefully learn a lot. If you have questions, shoot us an email, give us a comment. We always check those out. Like and subscribe. We really appreciate it. Share it on your social media platforms. We appreciate all the support and help that you guys give us. So we'll look forward to seeing you guys next week.
The hosts of the Market Moment podcast are employees of Mach 1 Financial Group, LLC. Mach 1 is a registered investment advisor located in Rogers, Arkansas. A copy of Mach 1's current written disclosure brochure is available through the SEC website and available at disclosures.mach1fg.com.